The Debt Management Office has offered 2 new federal government of Nigeria savings bonds for subscription at 1,000 naira per unit. Dipo Ajayi, head of fixed income and FX at Chapel Hill Denham, joins me to discuss how the market is shaping up for the week. Thank you so much, Dipo. Always a pleasure to have you.
You're welcome.
And of course, good to have you back also in the studio. Talk to us about this the savings bond, two new offerings. What do we need to know?
Yeah, for this weekend, there's going to be a retail savings bond. Of course, we know that is targeted at the retail end of the market because, for you to be able to invest in the normal fixed income market, you need to have about over 50 million naira. So at that point in 2017, the government came up with this to actually attract people, the retail end of the market. So, and funny enough, the minimum amount for this is just 5,000 naira. So, and the tenor is short-dated 2- and 3-year bond. So for this week, it's done once every month, and it's like an open offer for a week. So it's as open today and going to close on Friday. And that is, and sincerely speaking, if you look at it, the rate is actually a bit attractive compared to.
Oh, absolutely. And is this one of those bonds where we can expect an oversubscription? Of
course. In recent past, we've been seeing a lot more information around that, and a lot of brokers have been actually driving the business around that seriously, because they know currently some of them are thinking, of course, putting your money in savings account is no more very attractive. So, and again, one good thing about it, unlike normal bond, the coupon they are paid quarterly. So what that means is that a lot of investors in that phase can actually get a lot of cash flow, quarterly cash flow around that.
Absolutely. I want to quickly get your thoughts. I just remembered now the Eurobond, the federal government Eurobond that has been suspended. Well, apart from the fact that the DMO or the finance minister did say that market conditions are not too favorable, she also did say the approval window had closed or something like that. But what are your thoughts? Because it just makes me think, what are the options?
I think it's more of the pricing. Because we lost the opportunity last year, September, when we should have taken that opportunity.
But we did go in March this year.
But we could have gone. That's exactly. So we had another window this year. So we should have capitalized on that window. Because at that particular, it's crystal clear that yield will continue to go up considering the environment. So I just feel that last year would have been our best chance, but another window opened in March, but we couldn't take advantage of that.
But we didn't know the central bank, we didn't know the Fed was going to have
multiple.
We knew the Fed will have multiple hikes
because
this year.
Now, when you consider the fact that inflationary pressure is currently biting globally, it gets to a level that you know that, and even last year, December, Fed gave a forward guidance around rate hike. And they even mentioned that you can see as much as 6 rate hikes in this year. So we should have factored that into our own model and go bullish in March, since we didn't take advantage in September. So we lost that window. And the penalty for that is we have to pay high price.
When you say high price, meaning we will still go? Because I was asking a trader earlier, will the window present itself at some point?
So now, for me, it may likely get worse in terms of rate. Because if the Fed is of the view that we are still going to see more rates hike this year, so of course market will always price that into our pricing when you're coming to the market. So for me, if we know at the end of the day we still want to go to the international market, I'm still telling you this time is still the best time. Because if we are still expecting rates to see Fed to see hike rate by close to 100 basis points, of course that will still be markup on the pricing of the instruments. So now it's still another opportunity that is being opening. But if we don't take it, then that means that we have to change that strategy. Maybe we have to now focus on local borrowing. And the impact of that is that the federal government will likely crowd the local market. And that's what would that mean to corporate borrowers?
Well, that's an interesting scenario. The government hasn't said anything in terms of next steps. I guess we'll wait for that. I mean, I was talking earlier to another analyst about development DFIs, concessionary rates, where options.
Of course, we have windows like that, but I also want to be very sure that we need to know: do we still have open lines on those windows? Because I know we are taking a lot of loans on those from those institutions
already.
So we have to be very sure that we have lines to still be able to access some of those.
Okay, let's come back to the domestic market. Talking about the corporate bond market, how is that shaping up so far?
Yeah, for now, we've not been seeing a lot of activities around that because currency rates is hike, yields are going up. And at the same time, another thing is that January, when the FRS came up with tax on corporate instruments, I know very well that will also affect that, because it means that anybody that wants to buy instruments like that, they also now have to benchmark with federal government bond that is tax exempt. So it means that most people that will be coming to the market in that direction, they will have to come big. on their rates for market to actually embrace it.
It's definitely looking more a very, very interesting market so far. Let's talk about the FX market quickly. We're still seeing the reserves declining. Oil prices above $120. NAFEX, INE still trending. What can you tell us? What do we need to know about the market? Or is it the same old status quo?
I don't think anything has changed. The only thing that we feel that is still currently ongoing is the fact that CBN has been actually servicing the FPIs in terms of selling funds to them, which to me, one way or the other, sounds good. Maybe if they have told this line a long time, maybe we would have cleared those lines, and maybe some of them will actually have convenience in the market. And you know very well, yields are actually not at those exciting level that can lure anybody into the market. But even if they are at that level, you also want to consider the exchange rate risk when you are coming to the market. And just like what you said, oil price is going up, but the reserve is actually dropping. It tells us that I think our problem is bigger than what we can see directly.
Absolutely.